when the world at large experiences inflation for what it is, against their standard of living, they will respond, Michelle.
They will respond by going into gold.
Among other things, by going into gold.
That is very well said. Inevitable is not necessarily imminent. Well, interest in the rate of inflation has really been frustrating to a lot of gold investors because we seemingly have the perfect storm for gold prices to rally. As I say, we have inflation at a 40-year high. The idea of a recession potentially looming creates more uncertainty. Equity markets very much in the red, crypto markets very much in the red, and we still have heightened geopolitical risks. We still don't know how this Russian invasion of Ukraine plays out. We've got China in fresh lockdowns because of COVID. Iran is restarting its nuclear program. North Korea, just for fun, fires a missile here and there. So there's still a bit of geopolitical uncertainty, and yet gold is staying more or less flat. Now, granted, it is struggling against the strong US dollar, but at what point do you see gold breaking out of this 1800 range and making significant headway?
That's the $64 billion question. I love that question. When we discussed inflation and interest rates earlier, what I tried to say was that people's expectation of the future is set by their experience in the immediate past. And their experience in the immediate past has been benign. I, unlike you, lived through the decade of the 70s in terms of inflation. 1968, 1969, 1970, 1971, the hallmarks of inflation were there. You could see that inflation was coming, but it was an academic topic because it hadn't bitten people yet. And inflation hasn't bitten people yet. When people understand that their 3% increase, wage increase, is a 5% wage decrease in purchasing power terms, when people see their life savings tied up in bonds yielding 3.5%, while the purchasing power of those savings has declined by 8.5%, when they've been victimized by inflation for 2 years or 3 years or 4 years, like they were in the early 70s, then inflation will be front and center on everyone's mind, like it was then. You and I have lived since 1982 in the most benign economic period in the history of mankind. We aren't afraid of much of anything, and you and I are symptoms of the world at large. When the world at large experiences inflation for what it is, against their standard of living, they will respond, Michelle.
They will respond by going into gold.
Among other things, by going into gold. Absolutely.
Well, one of the reasons that we've had discussed that we're not seeing inflation lead to a rally in gold prices and that we're not seeing gold perform as expected has been this idea that the gold price is manipulated. We recently had Frank Giustra on the show, and he says that he does believe that there is manipulation of the gold price via the derivatives market. I know you and I have discussed silver manipulation in the past and the fact that there is more paper silver than there is to cover physical silver. But what is your take on this idea that there could be some grand scheme to intentionally suppress gold prices?
The caveat that you put in place for Frank, which is to say that gold is manipulated in the derivatives market, which is to say that short-term gold markets are manipulated, I wholeheartedly agree with. I believe that all markets are and can be manipulated in the short term. If they can manipulate a market the size of the US Treasury market or the LIBOR market, for sure they can manipulate the gold market. It's different saying that than saying that there has been some long, thoroughgoing conspiracy to depress the price of gold. The very strong US dollar and the lowering of interest rates that's occurred in the period 1982 to 2022 obviated the need to do that. Gold went down all by itself. It didn't need any help from manipulation. Now, a circumstance in the derivatives market where, in a market like gold or silver, where 100 times the volume of gold available for delivery trades on a daily basis in futures markets, is ripe for manipulation. The idea that you could short a forward position 6 months out, 12 months out, 18 months out, borrow physical gold, dump it on the overnight market to cause the physical market to kick down and cause the leveraged derivatives markets to kick down. That type of manipulation? Absolutely. The idea that there's some vast conspiracy between governments and central banks and the Trilateral Commission to depress the price of gold when history has depressed the price of gold seems silly to me. I mean, look at the supposed players. The government can't deliver the mail. They can't educate the kids. And they can preside over a 40-year manipulation of the gold price? I don't reckon.
Well, what would be interesting is for you and Frank to hash this one out.
I would be surprised if Frank and I had too much disagreement. I would love to do it. If what Frank is saying is that people can use the derivatives market in the near term to manipulate the price of gold, he would be 100%, he and I would be 100% in accord. If Frank believes, and by the way, I have a huge amount of time for Frank. If Frank believes that there has been a thorough, ongoing, politically inspired manipulation to depress the price of gold, I'd love to have the debate with him.
All right, sounds like a potentially interesting conversation there. So, Rick, given this environment that we've discussed, what would you say is the best way for an investor to position themselves?
First of all, as we talked about before, this is really controversial. Investors have to have cash. Despite the fact that cash in the bank is costing you 8.5% of your purchasing power, that negative interest that you experience is an option premium to take advantage of volatility. And volatility we're going to have lots of. So the first thing is have cash. Please, please, please have cash.
Cash is not trash, as Ray Dalio says.
Cash is not trash. Emphasize quality in your investments now. Don't go for stories. Don't go for the narrative. Go for value. Absolutely, positively have exposure to commodities. Absolutely, positively have exposure to precious metals. I run into investors that have 100% of their portfolio in gold, which is insane. But the overall market, the market share of precious metals and precious metal securities relative to other savings and investment assets in the United States is 0.5%. Most investors can't even spell gold in a circumstance where inflation is eating away their savings at an ever-increasing rate. That's a mistake too.
Are there any particular commodity companies that you would highlight?
With the caveat that there's no one-size-fits-all for all investors,
Sure, yeah.
I would suggest that investors who are historically underweight precious metals and commodities emphasize the highest quality commodity companies. In other words, I would emphasize staying away from the juniors, buying names like Exxon, buying names like Chevron, buying names like Occidental, Rio Tinto, BHP, Glencore, Vale, the highest quality companies with the best balance sheets, the longest lived reserves, companies that can withstand volatilities, companies that can withstand a hiatus in capital markets. Right now, with things as uncertain as they are, buy the best, because the best are falling in price just like the rest.
Okay.